AS 19, it talks about leases. So everything in connection to lease agreements are covered under AS 19. So it talks about how accounting mechanism should happen in both books of lessor as well as lessee. Now, first thing, what do we mean by a lease agreement? What do we mean by lease? Okay, first, it is supposed to be an agreement. So lease is supposed to be an agreement where lessor transfers possession of asset, to whom? To lessee for specified period of time, in return for specified rentals. The specified rentals will be called as lease rentals. So this is going to be the meaning of the term lease in our AS 19 requirement. So first, it's an agreement. This agreement is between a person called as lessor, who is the actual owner, the legal owner of the asset. He is going to hand over the possession of the asset to another person called as lessee. Lessee is going to collect the asset. Then for a specified period of time, we call it as lease term. Specified period of time, we call it as lease term, in return for lease rentals. So basically, altogether, what is going to happen then? Altogether, asset will be shifted from owner of the asset to a user of the asset for certain time for certain payment. That is going to be called as leases. So if there is a contract based on this, it is going to be covered up in our accounting standard. Now, how do we deal with the leases now? So for the accounting requirement, leases are supposed to be classified into two. Classification. What type of lease we have? First, we have finance lease. Then you have operating lease. So either it is going to be financing lease or it is going to be operating lease. Okay. Now the point comes, what do we mean by finance lease and what do we mean by operating lease? First, why is this classification? Because accounting requirement of these two leases are separate. They are different. For accounting needs only, these two classification has taken place. Okay. So the first thing what I need to know is, what do we mean by finance lease? So finance lease basically means, in this lease, substantial risk and reward of asset is transferred. So lessor is not just giving the asset to lessee. Lessor is giving the substantial risk and reward related to that asset to lessee. Okay, so what does that basically mean? Basically what it means is, the underlying asset what you have, lessee is the person who is going to get the major benefit of the asset. As simple as that, because lessor is going to shift the substantial risk and reward of the asset to lessee. So accordingly, lessee is going to get the maximum benefit of the asset in his hands. Okay, so accordingly then, when do you call something as finance lease? When do you call something as finance lease in a particular scenario? We call them as indicators. Okay, sometimes they will ask a question, they will create a case study for you, and in that case study they are going to ask you, is this finance lease or not? At that time, according to these indicators, you can check and tell them that whether it is finance lease or not finance lease. First, indicators wise, the first indicator is, after lease term, asset sold to lessee. after the lease term, the asset will be sold to lessee. So that is one type of financing lease requirement. This is one indicator. Now what happens? Lessee during the lease term has the asset in his hands. After lease also he will have it. So it's as if ownership is shifted to that person. Significant risk and reward. Then the second one, option to buy at the end of lease term. Option to buy at the end of lease term. So at the end of lease term, there is an option to buy for the lessee, and it will be in such a price that lessee will opt for the purchase. So you are certain that lessee is ready to buy the asset. Again, that is also an indicator of financing lease. Then third one, lease term covers maximum useful life of asset. Okay, so the lease term, what is decided, covers the maximum utilization or maximum useful life of the asset. Example, 10 years is the useful life of the asset. Lease is for 8 or 9 years. Substantial time, lessee is only going to use it. So automatically what happened? Significant risk and reward is going to be transferred. Okay, then fourth one. So the fourth requirement will be, present value of minimum lease payment covers fair value of asset. Okay, from the valuation point of view, present value of minimum lease payment is going to cover the fair value of the asset. Okay, we'll now decide what are those present value of minimum lease payment and all will come later, but this is again another indicator to tell whether it is finance lease or not. The last one, nature of asset is such that only lessee can use it. Nature of asset is such that only lessee can use it. Other people, if lessee says, no, I don't want the asset, lessor can't give this asset to anybody else. At that time, what happened? Again, significant risk and reward. So all these indicators are just going to tell us that it may lead to finance lease. Okay, combination of more than one. So there could be other situation also, but the important one is this one, which we decided. Substantial risk and reward is transferred on the asset. Now these type of leases are called as finance lease. Okay, then what are operating lease then other than finance lease are operating lease? So in operating lease, substantial risk and rewards are not transferred, which means the lease term does not cover the majority life of the asset. So maybe a year might cover or 2 years, it doesn't cover the majority life, then there is no substantial risk and reward transfer. These things will be your operating lease, the normal one. So these are the two types of leases what we have, and accordingly the accounting is going to be different. Now talking about the accounting aspects, so accounting wise, first let's see what are the accounting requirements of finance lease. Not just that, we have to see how these leases are accounted in both the books. You have to see it in both the books. Now, there are a lot of formula involved whenever we calculate, and I'll try to cover the formulae first. Logic wise, it may be easy, it may be difficult for some people. So logic, I will not touch too detailed into it because it is revision and you want to learn mainly from the exam point of view. So therefore, I will mainly go with simplifying the formulae for you so that it becomes easy for you to cover it up. So I will not talk much about the logic behind those formulae, but we'll mainly talk about the formulae because again, since it is revision point of view. Now, finance lease point of view, when it comes to accounting, first I will deal with what happens in lessee books. Then we will see what happens in lessor books. So first, let's see what happens in lessee books. Now, when it comes to lessee books, the highlight things what we have to understand when it comes to finance lease is concept of substance over form will apply. So this particular concept we had seen when we dealt with the first group accounting in AS1. So what do we mean by substance over form? The economic and financial benefit of an asset is more important than the legal form. So if you now apply it over here, what is finance lease? Substantial risk and reward is getting transferred, which means even though lessor is the legal owner of the asset, lessee is going to utilize the economic and financial element of the asset. Therefore, asset will be recorded in lessee books. So what is the effect of substance over form? Asset recorded in lessee books. Asset is going to be recorded in lessee books and not lessor books. Even though lessor is the legal owner of the asset, it will be recorded in lessee's books. Okay, same concept is applicable in your hire purchase also, because hire purchase is also covered by AS 19 itself. Okay, and it is a kind of finance lease itself, because it is given for substantial period of time and it will be sold at the end of the lease term. Automatically the ownership will be transferred to hire purchaser. Okay, now asset is recorded over here. For that, obviously a liability will also be created. So liability created will be what? Lessor account. So asset will be recorded in my books, for which a future payments will be made in the form of lease rentals. So therefore, the asset involved, liability will be lesser. So these two things will be created, and this will be created at what amount? Asset recording and liability recording will be done at what amount? The amount involved for this is present value of minimum lease payment from lessee point of view, or fair value of asset whichever is less. Okay, so basically what does it tell us? It just tells us that you have to record your asset in the books of lessee. Okay, great. At what value should I record? I should record it at present value of minimum lease payment from the lessee point of view, or fair value of the asset whichever is less. Point to be remembered, this is normally given in the question. Fair value is basically what? The actual value of the asset, which will be dealt it in a knowledgeable market under arm's length price. So under arm's length price in a fair market, if at all a particular asset could be bought and sold, at what value will it be bought and sold? So that will be fair value. It will be normally given in the question. But present value of minimum lease payment you have to calculate. So what is the way in which present value of minimum lease payment has to be calculated? So present value of minimum lease payment from lessee point of view is equal to lease rentals plus guaranteed residual value by lessee. Okay, lease rentals plus guaranteed residual value by lessee. Now the point is, this lease rental plus guaranteed residual value will give you minimum lease payment from lessee point of view. Take present value of this. If you take present value of lease rentals plus present value of GRV, guaranteed residual value, then it is going to become present value of minimum lease payment. Okay, now the point is, what do we mean by lease rentals? We have already seen the periodic payments. What the lessee is going to do to the lessor is lease rentals. What is guaranteed residual value? If at all lessee promises any residual value to lessor, which is as a part of agreement, then it is called as guaranteed residual value. So lessee may give a guarantee. It doesn't mean that lessee will give it. Lessee may promise payment of certain realizable value to lessor at the end of lease term. So this comes at the end of lease term. This comes at the end of lease term. Okay, if at all he promises, then it will be in the agreement and it's a part of minimum lease payment, because I have promised it. I have to pay to the lessor now. So this is going to be the value through which you are going to decide at what value asset will be recorded. This is point number one. Now the second point. Whatever lease rentals the lessee is going to pay, which we have decided na, that present value of minimum lease payment point, lease rentals will be paid every year by the lessee. Now this either will be in finance charge or and it will be as a part of liability payment. So your lease rentals, whatever you are going to pay, will cover finance charge and will cover liability payment. Now what do we mean by that? Basically, if the value of the asset is 10 lakh, lease rentals cumulative, total lease rental what you are trying to collect will obviously be more than 10 lakh. Why? Because you are paying on a delayed basis, which means kind of interest will be collected by the lessor from the lessee. It's not just the payment for the asset. If you make the immediate payment, it will only be towards asset. But if you make a delayed payment, it's also for extra payment for delayed payments. That is finance charge. That is the expense to the lessee. Other part is for the asset, which is liability payment. Because asset payment basically is lesser account. Connected liability will also be created, that is supposed to get paid. So therefore, finance charge and liability payment are the coverage of the lease rental. Then next, finance charge is recorded over life of lease term. So over life of lease term, the total expense, if I have to give you an example, 10 lakh is the value of the asset. Okay, 10 lakh is the value of the asset. Lease rentals is 3 lakh for 4 years. Actual asset value is 10 lakh. Lease rental is 3 lakh for 4 years. So what's the total payment? 12 lakh. So what is happening here? 10 lakh will be towards liability. 10 lakh will be towards liability, which is lesser account. What is that extra 2 lakh? That is finance charge. That 2 lakh finance charge in total will be recorded on a rational basis over the period of lease term. So over the lease term, it is supposed to get recognized, which is their expense involved in the lease contract. Okay, so not entire lease will be an expense to lessee. Part which is finance charge is a part of lessee, other things won't be a part of it. It will be payment of liability. Now if you could remember, AS16, there is one point. What are borrowing cost? One, finance charges under finance lease. So that is the thing which you discussed right now. So that is coming under borrowing cost. If the asset is qualifying asset, then borrowing cost is incurred, etc., etc. Okay, next, finance charge is recorded over the life of lease term. 4, depreciation is recorded in lessee books, and this will be recorded according to AS10 principles. So what is his normal principles of AS10? That is covered over here, and depreciation will be recorded in lessee books. Finally, for present value, what is the discounting factor? Because you have learnt FM. So for present value, you need a present value factor or a discounting factor. What it is? Either it is interest rate implicit or implicit rate of interest. Okay, we call in both names, either interest rate implicit or implicit rate of interest. If not available, lessee's incremental borrowing rate. Lessee's incremental borrowing rate. Okay, so this is supposed to be the discounting factor to get the present value. Either it is going to be interest rate implicit or implicit rate of interest. Okay, that we will discuss it in detail a bit later. Or if interest rate implicit is not there. So interest rate implicit is basically through the point of view of lessor, there is a rate which we are supposed to find out, which we, again, as I've said, we will discuss later. If that is not available, then according to incremental borrowing rate of interest for your lessee, it has to be considered. Now, what do you mean by that? A similar lease is taken from another lessor. At what rate the lessor has given it to you? That is your incremental rate. So either consider that, or there is no lease about it at all. Then what should I do? Consider if at all you are supposed to buy it as a borrowing. You borrow the money and you buy the asset. At what rate you are supposed to borrow it? That will be the rate applicable over here. So either according to similar lease or borrowing rate. If you are supposed to buy the asset on your own, and if you borrow it and buy the asset, if you borrow funds and buy the asset, at what rate you are going to borrow funds, that will be considered for this particular purpose. Because vehicle, it might be different, a structural element, it might be different, etc, etc. So at what rate it is supposed to get considered. So accordingly, finance lease will be recorded in lessee books. So whatever we discuss now is financing lease, how it should be recorded in the lessee point of view. So whereby this is how it is supposed to be done. Asset will be recorded, liability will be recorded, finance charge will be written off over the life of the asset, and so on. So those things you have to cover up. Once you will see these formula and all, I hope it will be very easy for you to bring it up. The next one, what happens in lesser books? So from the lesser books point of view, what are they supposed to do it? Okay, so from lesser point of view, the asset under lease agreement not recorded. So asset under lease agreement is not recorded because it is already recorded in lessee books. So it will not be recorded over here. Correct? So whatever is happening in the lease will be covered up as a receivable amount for lesser. For your lessee, it's a liability. Lesser account is a liability. For lesser, lessee account is a receivable account. It will be shown in the balance sheet. So in the balance sheet, lesser is going to show this particular asset as receivable from lessee. Okay. Now the point comes, at what value will it be done? So the amount to be considered for this is net investment in lease. Net investment in lease. So point to be understood, please remember certain terms very well. Suppose in the exam they ask you calculate net investment in lease, they will just tell only that, they won't tell under whose point of view. Net investment in lease is done only in lesser books, nowhere else. Asset is recorded only in lessee books, nowhere else. So therefore, never go with that kind of understanding now. If question is silent, in which books it should be done, now don't start getting confused. Where should I do it and all? Terms you have to look into it. According to the terms, work on it. So if at all they say net investment in lease, gross investment in lease and all these stuff, it should and must come under lesser books only. It won't come under lessee books. Okay. So amount at which the receivable balance will be shown will be net investment in lease. Along with that, what else? So what do we mean by net investment in lease then? Net investment in lease is equal to gross investment in lease minus unearned finance income. As I have said, I will mainly deal with formulae. Gross investment in lease minus unearned finance income, which means it gave us two more terms. One is gross investment in lease, second one is unearned finance income. Now, what are the formulae to calculate these? Now, gross investment in lease, yeah. So, gross investment in lease is equal to minimum lease payment from lesser point of view plus unguaranteed residual value. Minimum lease payment, lesser point of view plus unguaranteed residual value. This is the first formula we have, whereby which is gross investment in lease. Now what about the second one? Second one, it is about unearned finance income. So unearned finance income, I will write it as UFI, is equal to gross investment in lease minus present value of minimum lease payment lesser plus UGRV. So in the sense, present value of minimum lease payment lesser plus present value of UGRV. Therefore, I have taken one bracket. I will put the bigger one. Okay, so present value of minimum lease payment lesser plus UGRV, that present value is considered as the second one. So now, if you could look into these two formula, gross investment in lease formula and unearned finance income formula, there arises another thing, third requirement. What is minimum lease payment lesser point of view? What is UGRV? Okay, now in the next unearned finance income, there is no new thing. It is directly gross investment in lease and present value, that we can do it. Now, first, what do we mean by minimum lease payment lesser? So minimum lease payment from lesser point of view, what does it mean? It means lease rentals plus GRV by lessee plus GRV by third party. Okay, so basically MLP lesser, minimum lease payment lesser point of view. What does it mean? Lease rental covered. Because let's see, whatever lease rental is payable, for me it is receivable. Number one. Second, if let's see has promised a guaranteed residual value, it will be receivable by me. Number two. Number three, if there is any third party who has guaranteed anything for me, then it is even considered over here. So suppose if lessee may not pay, a third party is ready to pay. So somebody has signed on behalf of the lessee saying that I will give you the money. I don't mind. For me, receipt is important. This won't be included in lessee books because lessee did not do it. Na? It is done by a third party. So it is not out of pocket expense for lessee. So he won't consider it. But lesser, wherever the amount is collectible, it will be considered for lesser books. So therefore, that will be considered as GRV third party. If at all third party is in a position to guarantee, and if he has guaranteed it, then I will collect it. So that's how we have to consider it from the MLP lesser point of view. Later, what do we mean by UGRV then? The last one. What do we mean by UGRV? Unguaranteed residual value is the full form. UGRV is equal to total residual value minus guaranteed residual value. Okay, total residual value minus guaranteed residual value. Now, point to be understood, listen to this very carefully. Guaranteed residual value, there is a money, there is a contract, it is already covered, you will collect it. But unguaranteed residual value, there is no surety that you may collect it, you may not collect it. Therefore, unguaranteed residual value is always estimated. What else? This estimation, just like AS10 requirement, this estimation should be reviewed every year. And if at all you find that the residual value is reducing, reduce it. Increase, leave it, but reducing, reduce it. So for example, at the beginning of the lease, you assumed that unguaranteed residual value is 1 lakh. You estimated it. But after 2 years, you are now coming to know that it's not 1 lakh anymore, it's around 70,000. Then reduce it. You should review it every year and accordingly you have to reduce them. So this is the requirement of formulae from the point of view of lesser books. And considering these only, you have to consider unearned finance income. So unearned finance income is what? Gross investment in lease done in formula number 1 minus present value of minimum lease payment plus UGRV. So therefore what happened? Same minimum lease payment UGRV only, but you have to take the present value. So a question comes, what should we consider for present value then? For present value again, consider implicit rate of interest. Implicit rate of interest. Okay, again, as soon as I finish with the lesser point of view, I'll tell you about what do we mean by implicit rate of interest. Okay, now after this, the next requirement is just like finance charge in the books of lessee, here it's going to be finance income. Finance income recorded over life of uh, recorded over life of lease. Okay, according to the life of the lease agreement, you have to record the finance income. That's the next requirement from the lesser point of view. And no depreciation levy, nothing. Depreciation will be levied in the books of lessee itself. Here again it will not be done. So this is the requirement in the books of lessor. So lessor has to consider it like this. He should show the receivable amount under net investment in lease, number one. Second, consider the finance income on year-to-year basis. That will be his income. Now comes a question as to what do we mean by implicit rate of interest. Implicit rate of interest. Okay. Now, basically, this is just that rate of interest where first present value of minimum lease payment lesser point of view plus present value of unguaranteed residual value is equal to fair value of asset. Okay, implicit rate of interest is that rate of interest where present value of minimum lease payment lesser point of view plus present value of UGRV is equal to fair value of the asset amount wise. Okay, now the point is, it basically means that what is the discounting rate is the question. That is going to be your implicit rate of interest. So at what discount rate, if you apply, the present value of MLP lesser and UGRV will be equal to fair value of the asset. It's more like IRR, what you do it in your financial management. So in financial management under capital budgeting or long-term asset analysis and all, you will now deal with something called as IRR. This is also almost similar. So how do you get that discounting rate? This discounting rate you try to calculate according to trial and error. According to trial and error, you are supposed to calculate it. So you have to first assume the rate. Accordingly, you will see. So accordingly, if you could apply it on your present value of minimum lease payment lesser and UGRV, one amount will be more than fair value. One amount will be less than fair value. Then interpolate the formula, you have to get your interest rate. So this is similar to IRR calculation, what you normally do. Okay, but that is how implicit rate of interest will come. That rate will be considered for finance charge under lessee books, finance income under lessor books. So if you now remember, in both the books we use that in implicit rate of interest. This is how that rate will be calculated. Okay. Now, few things I just want to tell you so that you can understand them. Number one, I have shown you lessee point of view, correct? And lessee point of view, what did we say? Amount wise, we said that it will be considered according to present value of minimum lease payment lessee point or fair value of the asset, whichever is less. Okay. Now for that present value of MLP, what did we say? Consider the discounting rate. What is that? Implicit rate of interest. Now assume that you considered a discounting rate and you applied it. Now say that particular PV of MLP, what you calculated, came to 8 lakh, fair value is 10 lakh. So if PV MLP is 8 lakh and fair value is 10 lakh, what do you say? Whichever is less. So 8 lakh will be done. And accordingly you go on. How do you calculate finance charge? Calculate finance charge according to this discounting rate itself, assuming 10%. Calculate finance charge every year. That's how it will be done. I will show you the table also. How do we get the finance charge and the finance income? Consider that rate and do it. However, if at all you consider 10% discounting rate, okay, you consider 10% discounting rate and what value you got, maybe you got it as 12 lakh. When you apply 10% discounting rate, you got the value as 12 lakh, but fair value is how much? 10 lakh, whichever is less. So which one will you consider at that time? 10 lakh. Now the point is the interest rate might be different now, because at 10% interest rate, you got your present value minimum lease payment as 12 lakh. So 12 lakh, if you bifurcate, 10% rate is correct. But if you are bifurcating 10 lakh, the rate will be different. You have to recalculate the rate. So you have to recalculate the rate according to that implicit rate of interest ka logic, whatever I have told you. Accordingly, you have to recalculate it and then decide how much is the rate accordingly. So in the exam, compare present value minimum lease payment and fair value. If you get either equal to each other, or if present value is less, no problem at all, continue your answer, same rate of interest will apply. However, if fair value is less than PVMLP, then recalculate the interest rate according to the logic of implicit rate of interest. Okay, that is one extra job you may have to do if at all it doesn't tally. So 10 lakh is lesser, fair value is lesser, don't apply the old rate, don't apply PVMLP rate, because PVMLP rate is 12 lakh. No, that is not recorded. 10 lakh is recorded. Recalculate it. That is the job what you have to do. Okay. Now, accordingly, if at all I have to create a table for finance charge calculation. So for finance charge calculation, if we need a table through which we have to do it, this is the table in which we calculate. One, we write the year. Second, opening balance of the liability or asset, whatever it is. Then third, finance charge or finance income at implicit rate of interest. Okay, how do we do it? Basically, this is calculated as opening balance into rate. Opening balance into rate. After that, lease rentals, which will be either similar or different according to the contract. Then after that, liability payment or asset received. So what is liability payment? Basically, liability payment is lease rentals minus finance charge. So whatever lease rental is there minus finance charge, as I have told you, the lease rentals are paid for both finance charge as well as liability. So lease rentals minus finance charge will give you the liability payment. Ultimately, closing balance. Closing balance. How do we get the closing balance? It is opening balance minus liability payment. This is the table what we formulate to calculate it. Okay. So this is the table through which all the calculations of recognition principles and all will be done. How much amount measurement is supposed to be done. Okay. So year, either year 1, 2, 3, 4, whatever it is, opening balance, either the new value, which is the value decided in their books, asset value and all those things, that then finance charge is basically asset value into implicit rate. You'll write the amount. These rentals will be given in the question. Liability payment is lease rental minus interest. Closing balance will be opening minus liability payment. It goes on for year 1, year 2, year 3, year 4 and so on. Okay, so that's how this is the table way through which it should be done. So with this, we finish off with the finance lease mechanism. Important one from the exam, because majority of the questions are covered over there itself. Now comes the next one, operating lease. So we have to now see how operating lease accounting is supposed to be done in a particular situation. Now, operating lease, there is no much impact. It's a normal thing what happens. So when it comes to operating lease from the lessee point of view, okay, operating lease lessee point of view, first, no asset recognition. Substance over form does not apply in operating lease. Why? Because substantial risk and reward is not transferred. So lessor is the financial benefit holder also. He is the legal owner as well as financial benefit owner. So therefore, asset will be shown in lessor books itself. Here it is not supposed to come. So no asset recognition. Next, lease payments are purely your expenditure. These payments are totally the expenditure of the lessee. There is no change whatsoever. Entire lease payment will be shifted to P&L account, whereby it will be treated as expenditure. Okay. Third, this expense is transferred to P&L according to benefit derived. So whatever benefit you have derived out of asset, accordingly the expense will be shifted to P&L. So that's how lessee is supposed to consider. So no asset recognition, whatever expense is there entirely will apply for lessee. P&L shifting will be done according to the benefit derived out of the lease asset. So this is how you have to consider your operating lease lessee books. What about lessor? First, asset recognized in his books now. Asset is recognized in his books. Great. Then basically lease rentals will be his income. These rentals will be his income. Again, this income transferred to P&L on benefit basis. Income transferred to P&L on benefit basis. But only one thing, depreciation is charged by lessor. So since asset is recognized in the books of lessor, depreciation should be charged in the books of lessor. As simple as that. There is no extra nature when it comes to this particular point of view. Okay. Now, I will take one more final conceptual understanding. Once that is done, I will show you certain journal entries which is applicable. Okay. If at all they ask it, sometime they may ask it in the lessee books. So in lessee books, how journal entries have been passed, I will give you the format journal entry so that again it will be helpful for you. Now, starting with the last concept what you have under this particular standard is sale and leaseback transaction. Sale and leaseback transactions. Now, what do you mean by this basically? First, asset is sold and leased back from same person. So basically what you are doing is A, transferring the asset to B, this is sale, and from B again taking it back as lease. This is called as sale and lease back transactions. Okay. Now, sometimes they do the sale and lease back transaction just with the mentality of showing quick profits. So just to show some quick profits, they may do these sort of jobs. So therefore, AS 19 came in and said, whenever there is sale and lease back transaction, I will tell you how to recognize the profit or loss on sale. So profit or loss on sale, how to do it, that is covered over here. Okay. Now, first thing, if the sale and lease back transaction leads to finance lease. So what's happening basically? The thing which is happening is I have sold the asset to someone, leasing it back as a finance lease. So finance lease means what again? Maximum life of the asset is with me again. Say 10 years is the total life. After 4 years, I sold the asset. Then I took the asset for 6 years. Finance lease now, because the remaining life of the asset is 6 years. Lease term is also 6 years, which means maximum coverage is there. It's a finance lease. A question comes, if at all you want to take it back as lease only, why did you even sell in the first place? If you want to take it back on a finance lease, then why did you sell it? You could have kept it till the useful life of the asset. For that, again, institute comes to a conclusion that it may come under profitability mindset. So therefore it said, if sale and leaseback transaction is a finance lease, then profit or loss on sale proportionately recognized over lease term. So whatever profit or loss on sale is done by the lessor or not lessor, lessee over here, seller I will say, whatever profit or loss on sale is done by the seller, that will be recognized in his books over the term of the lease, which means what happened, whatever profits are earned divided by the term of the lease. Accordingly, he is supposed to calculate them. Okay, this is if it leads to finance lease. But important one from the exam point of view is if it leads to operating lease. If sale and leaseback turns according to operating lease, there are other set of rules. So what does it tell us? If that is the case, standard defined three terms. One, it defined selling value, fair value, and carrying value. Okay, SV or SP, selling value or selling price. FV is fair value. Third is carrying value. Okay, then always remember profit or loss is equal to selling value minus carrying value. Profit or loss is selling value minus carrying value. Why fair value came into the picture then? For recognition purpose. So fair value inclusion in this formula and all is only for recognition purpose. But actual value derivation is selling value minus carrying value. Then what are the rules involved? The first one, selling value is equal to fair value. Okay, so the first one is selling value is equal to fair value. At this time, profit or loss, immediately recognize, no problem. Okay, you have done it according to fair value, no issues, so immediately recognize it. Even asset taken is for operating purpose, which means it doesn't follow the substantial time. Second, if selling value is less than fair value, again the same principle, profit or loss, immediately recognize. Okay, but the problem comes if there is selling value more than fair value. Selling value more than fair value, how do we do it? Number one, there are two things what you have to do. First, till fair value, immediately recognize. Above fair value, defer over the life of the lease term. So defer over life of lease term. Defer over life of lease. Okay, suppose if it is selling value more than fair value, example, say carrying value is 100 rupees. Okay, fair value is 110 rupees. Selling value is 130 rupees. Okay, first, how much profit or loss has taken place? Compare these two. Profit total is 30. Now, what are they saying? Till fair value. So, now compare these two. Till fair value, how much? 10 profit. This is immediately recognized. Above fair value, how much? 20 rupee. This is deferred. Okay, so that's how the whole calculations will be done. So there is a question which I will be dealing with in the Q&A section. Over there, we will discuss this in detail because there is one question based on this. Okay, so this is again in connection to how are you going to deal with the operating lease mechanism when there is sale and lease back transaction. Okay, now the last part, if at all I have to pass certain journal entries, then how it is supposed to be done. The journal entries in the books of lessee. Okay, journal entries in the books of lessee. Because I will give you only one books, the other books automatically you would know because it will be opposite direction collectible point of view. Now, first, if it is finance lease, okay, if it is finance lease, the first entry will be asset account debit to lesser account. This is for your initial recognition of the asset. Okay, then finance charge account debit to lesser account. Finance charge account debit to lesser account. Okay, this is recognition of finance charge at the end of the year. Then lesser account debit to bank account. This is payment of lease rentals. Lesser account debit to bank account. Okay, then depreciation account debit to asset account. Depreciation account debit to asset account. Finally, P&L account debit to finance charge to depreciation. So this is how you will pass your journal entries there. So first is for asset recognition and lesser is a liability. Then later finance charge is an expense for lessee. So finance charge debit to lesser. Then payment of lease rental, lesser to bank. Then depreciation charged. Then all the nominal accounts will be shifted to P&L at the end of the year. So this is how you will pass the entry whenever you deal with lessee finance lease. This ulta will be considered for operating lease. So in in the books of lesser, this ulta. So how will you do it? Say if it is lesser books, I will write here only lesser. First, it will be lessee account debit. Most of the time, this will be considered as sales itself. So I will write it as 2 sales. But sales under lease, something like that they will show, but I'll consider it as sales. Then lessee account debit to finance income. Lessee account debit to finance income. Then bank account debit to lessee. Then depreciation won't come. Then finance income account debit to P&L. This is how lesser books the entry is supposed to get passed. Okay. Now, if at all it's an operating lease, and if it is lessee, first entry will be lease rent account debit to bank for the payment of lease rentals. So lease rent account debit to bank if you directly pay it off, or else lease rent account debit to lesser account debit to bank, because ultimate payments, and this is an expense to me. So P&L account debit to lease rent. P&L account debit to lease rent. This is how you will deal with lease rentals in the operating lease. It's very simple. As I've said, the entire lease rentals will be your expense. If it is lesser books, if it is supposed to be lesser books, basically at that time what happens, first asset account debit or asset under lease account debit to bank. This is for purchase. Asset under lease account debit to bank. This is for purchase purpose. Then after that, bank account debit to lease. Bank account debit to lease. Then later, depreciation account debit to asset, because depreciation should be charged by him. Then P&L account debit to depreciation, this is for depreciation shifting. Finally, lease rent account debit to P&L. This is how lesser is supposed to get considered. Basically, asset is recorded in his book, so therefore asset entry one extra. Second, depreciation charge is another thing. Other than that, rest everything is similar between lessee and lesser in the opposite direction. So this is how your journal entries will be passed. So once before going for exam, glance this up. If at all they ask the entries, you would know already as to what should be done. Okay, so with that, all the theory segment of AS 19 is over. Now let's quickly look into certain problems, and once that is finished, we will try to end this standard. First, classify the following into either operating or finance lease. This is your RTP question. If present value of minimum lease payment is equal to X, fair value of the asset is Y and X is equal to Y. Do you remember the indicators? Now indicators will help you over here. What did we write as one of the indicator? Present value of minimum lease payment is equal to fair value of the asset is a type of finance lease. So if what they are saying, present value is X, fair value is Y, X is equal to Y, it is a finance lease for us. It's a finance lease because it's a part of indicator. Second, economic life is 7 years, lease term is 6.5 years, but asset is not acquired at the end of lease term. Asset is not acquired at the end of lease term is okay, but majority life is covered under lease term only. Majority of the asset is used under lease term itself. So this is another indicator, which means this is also a finance lease. Third, economic life is 6 years, lease term is 2 years, but the asset is of special nature and has been procured only for the use of lessee. This was one of the last indicator I have told you in the revision itself. Asset is in the nature whereby only lessee can use the asset, others can't use it. This is also finance lease. Over here, term does not matter because this lessor cannot give this asset to anybody else. It could be given only to lessee. This is also finance lease. Okay, now look into the answer. The lease is a finance lease if X is equal to Y or if X is substantially equal to Y. Okay. The lease will be classified as finance lease since substantial portion of life of asset is covered by lease term. Third, since the asset is procured only for the use of lessee, it is a finance lease. So all the three are the indicators of finance lease. So that's why I said indicator. To some extent remember them because it will be useful for you in the exam. Easily you can score marks in the exam. Now the second type, Monu Limited sold machinery having WDV of 400 lakh to Sonu Limited for 500 lakh. So 400 lakh is carrying value, WDV, 500 lakh is selling price. And the same machinery was leased back by Sonu to Monu. The lease back was in the nature of operating lease. First, explain the accounting treatment as per AS 19 in the following cases. So, 4 different cases. Sale price 500 lakh is equal to fair value. First, calculate profit or loss. How do you calculate it? 500 minus 400. It's always selling price minus carrying value. So, 100 lakh is supposed to be our profit. Now, since it is equal to fair value, what is the rule? Immediately recognize. I will write it as IR. Immediately recognize. Okay, because if it is sale value is equal to fair value, it is immediately recognition principle. Then fair value is 450 lakh, sale value is 380 lakh. So what is happening here? Selling price is less than fair value. Sale value is less than fair value. Carrying amount is the same. So how do you get the profit or loss here? 380 minus 400. So there is a loss of 20. Even this also immediately recognize. Okay, because why? Because selling price is less than fair value. Now, third one, fair value is 400 lakh and sale price is 500 lakh. Fair value 400, sale price 500. First, profit or loss is what? 500 minus 400. This is 100. Now, what is happening? Above fair value. So, 400 is fair value. Sale value is 500 lakh. So, fair value and carrying value are the same. It's 0. But every amount of profit you have earned is more than fair value. So, what happened? Defer. This you have to defer it totally. I hope it is clear. Till fair value, immediately recognize. Above fair value, defer. Till fair value, the profit or loss is 0 because 400, 400. Above fair value is 100. That is deferring. Fourth one, fair value 460 lakh, sale value 500 lakh. Now what is happening? Total profit or losses 100. 500 minus 400. But how much is immediately recognized and how much is to be deferred? 460. 400 to 460. Till fair value immediately recognized. So 60 immediately recognized. Above fair value of 40, defer it. That's how it should be done. So you have to remember the elements carefully. So till fair value, immediately recognize. Above fair value, you have to defer it. So till fair value is 460 minus 400, 60, immediate. Above fair value, 500 minus 460, 40, defer. So total is 100, but treatment will differ. So now if you could look into it. Immediately recognize profit of 100. So what we discussed is same. Next, loss of 20 immediately recognized. Again, the answer is same. Third, 100 lakh deferred. Again, the answer is same. Fourth, 60 profit immediately recognize, 40 defer. So that's how you have to interpret the rules given by the standard. Sale and leaseback to some extent is famous again. They may ask it in the exam. So therefore, just look into the principles carefully and numbering carefully. Okay. So with that, AS 19 effect comes to an end. It's a bit larger one. At the same time, it's a bit complicated because there are a lot of formulae involved. So therefore, I tried to tell all the things along with the formula itself. So with that, it could be easily adjustable for you to understand the whole stuff. Okay. So with that, we finish off with the AS 19 discussion. Now let's move on towards the next accounting standard, which is AS 26. So AS 26, Intangible Assets. So when it comes to AS 10, we had discussed that AS 10 covers up only the tangible asset situation. If there is any intangible asset, it will be covered by AS 26 separately. Okay, so we have to now discuss the entire aspect of this intangible asset. What type of expenses might be incurred, what type of intangible assets are capitalized, how amortization of intangible asset takes place, etc., etc. Everything is covered by this accounting standard. Now, first talking about this standard is the scope. What is the scope of this standard? How it is covered up? First, it's a general accounting standard. So as soon as I use the term general AS, what should we think about it? If there will be any specific AS, this AS will be excluded. So let's see certain exclusions of this particular standard. So exclusions point of view. First, specific accounting standard. So if there is any specific AS, then this accounting standard is out. When is that possible? Number one, suppose if there is inventory. If there is intangible asset treated as inventory, it is kept as sale in the ordinary course of business. It will be covered by AS2, not by this standard. Next, if there are any deferred tax asset, it is covered by AS22, because even deferred tax asset to some extent are non-physical in nature. So you may find that there is intangible asset characteristic, but it is covered by AS22, not covered over here. The next one, there is goodwill during amalgamation and consolidation. There is goodwill which is covered during amalgamation and consolidation. This is covered by AS14 and AS21. So not covered over here. Fourth and the last one, if it is covered by leases, then AS19 is applicable. So any specific accounting standard, if it is covered, it is not considered in AS26. Only general stuff other than these accounting standard coverage is covered over here. Next, there is a second major exclusion, which are financial assets. So if there are any financial assets, they are not covered over here. It's not covered by AS26. Then mineral rights are not covered. Mineral rights are not covered. Then insurance contract with policy holders are not covered. Okay, so if there are any insurance contract with the policy holders, which is done by the insurance company, that is not covered. So every other things are covered. Say patent, there is goodwill, there is say softwares, those things are covered here. But only those contract with the policy holders are not covered by the purview of AS26. So these are the exclusions which is happening from the standard. Then the important aspect is, what is an intangible asset? We need to know now. What are covered by AS26 then? What are intangible assets altogether? First, let's see them rule by rule. It should be an asset. So first, obviously, if anything should be called as an intangible asset, first it should come under the asset definition. Second, it should be identifiable. It should be identifiable. Third, it should be non-monetary asset. Fourth, it should not have physical substance. It should not have physical substance. 5, it is used for first, production or service. Second, rental to others. Third, admin purpose. Now, if you could see the last usage point of view, you can make out that the same three rules were there even in AS10. PPE also, they were tangible asset used for production or service, rental to others, and admin purpose. Here intangible asset. So usage will remain the same. If at all it is held for ordinary course of business, AS2, it doesn't come over here. Okay, so now these are the rules to be called as an intangible asset. It should be asset, it should be identifiable, it should be a non-monetary asset, it should not have physical substance, it should be used for production, rental, or administrative purpose. So these are the coverage area for something to be called as an intangible asset. Okay, now let's see them one by one. So if at all it needs more conclusive remarks, we will see that, and afterwards let's move on for the next part. So first, what is an asset? It should be an asset is what they have mentioned. So what is an asset? First, asset is what? It's an economic resource. It's a resource for us. Then second, it should be controlled by enterprise. Controlled by enterprise. How is it controlled? By past events. By past events. What should happen from this resource? There should be probable future economic benefit. Okay, so this will be called as an asset. It's a resource. It is controlled by the enterprise. It by past event and future economic benefit is allowed from this particular resource. That will be called as an asset. So first it should be an asset. For an intangible asset, first it should be an asset. After this, it should be identifiable is what we mentioned. So we said that it should be identifiable. Now what do we mean by this identifiability? It basically means that it can be distinguished from goodwill. It can be distinguished from goodwill. How can something be distinguished from goodwill? By separable. So it should be separable. So distinguishable, I can say that how it could be achieved? It could be separable. Now what do you mean by separable point? It means that either it could be sold, or it could be rented, or it could be exchanged on its own. So all these sale, rent, exchange and all will lead to future economic benefit, and it could generate future economic benefit on its own. That is called as separable. Okay, for example, say I have got a computer software. So I have got a computer software. Now, can this computer software could be rented on its own? Yes, it could be rented on its own. Can I exchange this software for another asset? Yes, you can do it. Now, for this exchange of software, do you need the business to also come and negotiate? Not needed. Computer software can be negotiated on its own. Computer software can create future economic benefit on its own, which means computer software is identifiable. But think about goodwill. What did we write? We wrote distinguished from goodwill. Now, why that word goodwill is used over there? Now think about it. Goodwill is basically what? Your reputation. I want to say, for example, say you have got a shop adjacent to your house and you can see that that shop has got very good reputation. Can you only go and get that reputation? Can we only go and buy the goodwill of that concern? Not possible. If you want to buy the goodwill, buy the entire shop. So shop and goodwill are inseparable. You can't separate them. Company and goodwill, you cannot directly go and buy the goodwill of Reliance Industries. If you want to buy the goodwill of Reliance Industries, go and buy the entire company. You can't buy only the goodwill of it. So therefore, goodwill is not identifiable from its business. So that is why we said distinguished from goodwill. So how it is possible? It is separable. So from the business, this particular intangible asset should be totally separable. There should not be any link between them. Okay, this is your identifiability point of view. Then after that, what we wrote? We wrote that it should be a non-monetary asset. Now a question comes, if it is non-monetary, there is no money. If there is no money, how it will be considered as an asset in the first place? So first, get your meaning straight. Non-monetary asset does not mean no money. Non-monetary asset means no fixed and determinable value. No fixed and determinable value. This we had covered up in AS 11. The same meaning is covered here. Should not have fixed and determinable value, which means the underlying value of this asset keeps on changing. Over a period of time, the market value will reduce or there will be amortization on this, etc., etc. So it does not have a fixed value. It should be a separate one. This is about non-monetary asset requirement. Then, do not have physical substance or should not have physical substance. Now, what do you mean by should not have physical substance? If there is a physical substance, automatically it turns into a tangible asset. Okay, so basically what we say is dominance should not have physical substance. Now, what do you mean by that? The point is sometimes or most of the time, to hold an intangible asset, you will have a physical substance. Na? To hold it. For example, for computer software, there will be a pen drive, there will be CD, something like that, that will hold this particular software. For patent, there are legal papers, stamp papers, etc. that holds the intangible asset, which means to hold an intangible asset, you need a physical substance. But is that dominant? Whether pen drive is dominant here? No. The software in the pen drive is dominant. So therefore, dominance should not have physical substance. Only to hold it, only to keep it, if you have a physical substance, then it's totally fine. Okay. Now, for this, I will just add up one more thing. Suppose if there is an asset, okay, there is an asset which contains both tangible and intangible element. Both of them are tangible and both of them contains tangible and intangible element which are inseparable. They are inseparable. Then what should I do? I'll give you an example. Assume that there is a lift. Okay, there is a lift. Lift is tangible in nature, correct? Now to operate the lift, you need a software. So for the software to work, you need a lift. For lift to work, you need the software. Without that, these two doesn't work. So automated lifts, if you have, softwares are going to work for it. So if this is the case, then what should I do? Inseparable. They are inseparable in nature. Then in that case, first, if hardware is dominant, then consider it as tangible asset. If software is dominant, consider it as intangible. For example, the ones which I told you now, pen drive, disk and all, in that software is dominant. So consider that as intangible. Suppose lift, the example I gave you right now. Here, even though software is needed to operate the lift, lift is more dominant and valuable than the software, which means it is tangible, the entire thing. Even that software to work with this particular lift is also tangible only. You will not separate them as tangible, intangible, because AS26 does not talk about component basis. So it doesn't go with that idea. So if you are buying a computer, at that time, sometimes for the computer processors and all, there will be preloaded softwares. Now, if that is the case, then they are not separable. Entire thing will be called as computer itself. You will talk that or you will take that as tangible asset. So this is about that physical substance mindset as to how it is supposed to be done. Finally, the usage point, which you have already known, that it should be used for production, rent, or other administrative purpose. Admin could be anything, the additions of everything. So it could be selling and distribution, it could be anything to that matter to smoothly function the business. So this is about the intangible asset definition. Now, once we know the intangible asset definition, once we know what comes under intangible asset, then what is the recognition criteria? How can it be recognized in the books of accounts? How can be recognized in the books of accounts? For that, we say number one, probable future economic benefit should flow to the enterprise. Second, cost is reliably measured. Cost is reliably measured. Same as AS10. So I will not talk much about it. Basically, economic benefit should flow because of this. Say there is a computer software. You use this software for accounting purpose. So because you are using this software for accounting purpose, your accounting cost reduced. Number one, your accounting went on a smoother basis. Number two, administrative. So therefore, what happened? There is a probable future economic benefit. Then to buy this software, there is an amount. There is a cost. Because of this, this could be considered as an intangible asset. Patent again, you will have economic benefit out of patents. At the same time, patent will also have cost for purchasing them. So automatically what happened? It is an identifiable one. It is a thing which could be recognized in the books of accounts. So those things are covered as recognition criteria, same as tangible asset requirement. Then after this, the important one comes up, how initial recognition is done. We saw the recognition criteria, but how this initial recognition should be done in the books of accounts. There are different scenarios. We have to see them one by one. All the different scenarios we have, one by one, let's start looking at them. But the initial recognition, the overall idea is initial recognition should be done at cost. That's the overall idea. Initial recognition of the asset should be done at cost. But situations will change, and how do you generate cost in those situations? One by one, we have to look. Number one, purchased. Okay, outside you are going to purchase them. Purchase an intangible asset. At that time, how do you define cost? It should be recognized at cost for sure. How do you recognize cost in those situations if you have purchased them? Normal stuff, purchase price, add duties and taxes. Again, if no credit or no refund, then add directly attributable cost. Add directly attributable cost. Say for example, to acquire an intangible asset, you may incur certain legal cost. So there are different other types of cost which you may incur to get the intangible asset. So those things are considered as directly attributable cost, and it is allowed for capitalization purpose. Then if there is any trade discount, then deduct. So you have seen this in AS10, you have seen this in AS2. The same thing is covered over here as well. So any direct cost to acquire should be added, but duties and taxes are allowed only if there is no refund, then there is no credit. Deduct it by trade discount. This is your purchased intangible asset. So if you have purchased it from any other person, that will be covered over here. But point to be remembered, we don't talk about goodwill when it comes to this point. Purchased, what we are talking is a normal intangible asset getting purchased, not about goodwill. Then the second situation, if it is acquired in amalgamation. If it is acquired in amalgamation. So if it is acquired in amalgamation, first AS14 principles will apply to calculate goodwill and all. AS14 principles comes into the effect, agreed. But apart from that, there are certain other rules what we need to try and understand. Number one, if there is an intangible asset, I'll write it as IA from now on. If there is any intangible asset which has met recognition criteria has met recognition criteria then at that time recognize intangible asset in purchasing company even if not recognized by selling company. Assume that there is a patent, okay? By mistake or by oversight or anything, this patent was not recognized in the books. But when purchasing company is purchasing the selling company, at that time this patent came into limelight. Now purchasing company is acquiring that patent also. First, whether patent meets the recognition criteria, the answer is yes. Now even though the selling company did not recognize in the books, purchasing company can still recognize this intangible asset because this intangible asset meets recognition criteria separately. It could be valued. Then in those cases, you can recognize intangible asset. Now, second one, if IA do not meet that recognition criteria, I will write RC. If this IA, intangible asset, do not meet the recognition criteria, then if it is in the nature of purchase, then include in goodwill itself. So basically the point is, if you remember amalgamation in the nature of purchase, loss goes to goodwill, profit goes to capital reserve. Now goodwill is normally the balancing figure what you calculate while incorporation. This intangible asset will not be separately recognized. Instead will be a part of goodwill itself. Why? Because it's not meeting recognition criteria separately. Since it's not meeting recognition criteria separately, include it in goodwill or it will be write off in capital reserve. So accordingly, that is how you are supposed to bring it up. So if there is a recognition criteria usage, if it meets recognition criteria, there is a commercial ability for it. At that time, consider this intangible asset separately, even though selling company has not recognized it. However, if at all it is a part of intangible asset where it is not meeting recognition criteria, include directly in goodwill valuation, do not recognize it separately. So that's how you have to consider for acquisition in amalgamation effect. Then third one, if it is acquired through government grant, then what should I do? Two situation: when it is government grant, free of cost you acquire or you acquire it at concessional price. If you acquire it free of cost, then according to AS 12 principle, recognize this at nominal value. Suppose if it is acquired at concessional price, there is cost incurred. So therefore, recognize it at cost incurred plus any directly attributable cost. So if there is any directly attributable cost, consider that also. Say for example, government is going to give you say airport rights or anything like that at a very concessional price. But to acquire it, you have got lawyer charges and all, legal cost. Those things will be added to get your final product. So to get the final intangible asset, whatever costs are incurred, that will be added to the cost of the intangible asset. But do not consider fair value or anything. Cost incurred is supposed to come for valuation purpose. This is acquisition through government grant. Then fourth, issue of shares. So to get an intangible asset, you are going for issue of shares. You are not paying anything. Instead, you are going for issue of shares. You issue shares in place of intangible asset. How capitalization is supposed to take place? Now, for that we say capitalization is done fair value of shares issued or fair value of asset acquired, whichever is more clearly evident. So first, try to go with fair value of shares issued. See whether you can get it. If you could get that, consider that only, because cost, correct? So cost basically means from my pocket how much it's going. So if you get that fair value, then it's great. If it is not possible, then fair value of intangible asset, whichever is more evident. So according to the requirement, you have to just see which one is more evident for you, and accordingly consider the cost of the intangible asset. Then fifth one, if it is due to exchange of assets, you exchange assets accordingly, then what should be done? If there is any exchange of tangible assets towards an intangible asset, tangible asset to intangible asset, then go it according to AS10. Principles of AS10 you apply and finish it off. Any other assets to that matter, then go with the fair value mechanism. Any others, go with the fair value mechanism. So fair value of asset given up or fair value of asset acquired, whichever is more clearly evident. So accordingly, you have to see when exchange of assets takes place. Then the last and the most important one, self-generated assets. If there are any self-generated assets, then what are we supposed to do? How it is supposed to be capitalized? Number one, if there are self-generated assets, in the sense self-generated intangible assets, at that time, if it's first leading to goodwill, if there is a self-generated goodwill, okay, what are the problems with self-generated goodwill? It cannot be identified. So not identified, as I've already told you before, it cannot be identified separately to generate future economic benefit. It's always merged with business. So if business is sold, at that time goodwill will be generated. If business is not sold, it will be with you only. You can't separate business and intangible asset or goodwill. So therefore, it's not identified. Second, there is no cost. For self-creating a goodwill, to just check the self-reputation through profits or any other methodology, there is no cost incurred. Since there is no cost, since there is not identifiable, therefore, do not recognize it in the books. Very important. Self-generated goodwill is never recognized in the books of accounts. Don't recognize it. But what about other assets, other self-generated intangible asset? There is software, there is patent, there is copyright, there is movie rights, whatever it is. There are many other intangible assets which are self-generated. What is their situation then? Whenever you have got other intangible asset, we will allow for capitalization. It's not like goodwill, because they are identifiable, there is cost incurred, therefore we allow it. However, whatever you do, it will be allowed in this particular rules and regulation. What are they? So the total intangible asset generation ka life. So starting from day one, when you wanted to create an intangible asset, till commercial production, the last day, till then you will have two phases when it comes to an intangible asset. The first phase is called as research phase, and the second phase is called as development phase. So the first phase is called as research phase. The second phase is called as development phase. Accordingly, your entire cost will fall in either research or it will fall in development. Okay. Accordingly, the capitalization mode is decided by the standard. How? First, when it comes to research phase, what do we mean by that? It's original planning and investigation. Okay. Why? To acquire new knowledge. So basically you want to see the feasibility and all. So you start off by searching for it. You want to start something. So you start your research first. So it's a new thing. It's an original stuff. You will try to find out something new. You want to find out a new kind of patents. So for that you will start working on them. So new and planned decision what you take. But for acquiring new knowledge, will this directly create an intangible asset? No. Why? Because that may lead to positivity or negativity. Whatever you are trying to find, either it will lead towards a certain final conclusion, or you may have to drop the plan, because it keeps on getting research. You will keep on digging in. If it works out, you will work out. If it doesn't work out, you will stop it. So since research only leads towards only planning and trying to find out, whatever happens in research is always shifted to P&L account. Do not capitalize research phase at all. Okay, so you will try to find out a new knowledge. You will try to see which research finding is better. You will find 4 researches about the same topic. Then you'll start thinking which one is better. So all these things, you will say you will only go with one. You drop the other 3. Automatically what happened? Whatever you did is gone waste. It is not leading to intangible asset. So therefore, whatever is done in research phase is totally transferred to P&L. Now, what do we mean by development phase? What happens in development phase? Basically, here application of knowledge takes place. So, application of research, what you have done, that is taken up under development. So, in research, you find the best alternative. On that, you will start working on it. So, once you start working, there is a structure now in development. In research, there is no structure. In research, you will find which one is better. You will keep digging in to get knowledge. But in development, based on the acquired knowledge, you develop something, and that development may lead to capitalization. So we will allow capitalization under development phase provided 6 conditions are satisfied. Okay, first research, nothing doing, always P&L. Development, you allow it to capitalize if 6 conditions are satisfied. If they are satisfied, then capitalize it. If not satisfied, transfer it to P&L again. So it's very prudent that until and unless these conditions are satisfied, never ever go with capitalizing the development cost. Other everything will go to P&L. Only these things will be covered up. 1. What is the first condition? The first condition is there has to be technical feasibility. There has to be technical feasibility. Okay, that it could get completed, there will be proper intangible asset later, etc. There has to be a technical feasibility. Second one, there is intention to complete. So whatever you have planned for, there has to be an intention to complete that, not dropping in between. So if there is total focus that yes, it will get completed without any hiccups, then consider it. Then third one, there has to be ability to sell or use. Ability to sell or use. So basically, without ability to sell, you just generate something, it doesn't lead to future economic benefit, then there is no point. So there has to be an ability to sell. So once the ability to sell is adopted, then future economic benefit will come into picture. So this should acquire a future economic benefit for our consideration. So whatever you have doing, there has to be a future economic benefit through this particular asset. Then fifth one, there has to be availability of resources. Availability of resources. Your technical resources, financial resources, etc., etc. There has to be availability of resources. And the last one, there has to be ability to measure expenditure, because cost should be reliably measured, right? So ability to measure expenditure. These are the 6 conditions. So there has to be technical feasibility, there has to be intention to complete the asset, then it should be able to be sold or used, then there has to be future economic benefit, availability of resources, and ability to measure expenditure. If these 6 conditions are satisfied, then intangible asset development phase is allowed to be capitalized. Otherwise, P&L. Research always P&L. Okay. Now, in these development phase, we saw the conditions. What type of conditions will be considered for the purpose of capitalization? Now, let's see what costs can be included then. If you are self-creating a intangible assets, what costs are allowed to be created? These costs are allowed to be created. These costs will be allowed for capitalization provided they come under the 6 conditions of the development phase. Okay. Now, considering the first one, what costs are allowed to be included? Considering the first one, expenditure on materials. If you have taken any materials, if you have taken any services, those things are allowed. Second, salary cost directly related to IA, creation of IA, directly related to creation of IA, directly related to creation of IA. Then other directly attributable costs, other directly attributable costs. Then fourth, admin cost related to intangible asset. Okay, first expenditure on materials, if at all you use something, they. After that, salary cost. For example, say software is supposed to get generated, software engineers are needed, for them you pay salary, that is allowed. The time they have put in for the generation of the software, that salary will be allowed for capitalization. Okay, then if there are any directly attributable costs, say for creating one intangible asset you take patent rights from the other, that patent rights will be amortized. That is again included over here. Why? Because you are using the patent to generate intangible asset. Okay. Fourth one, any other admin costs. Say your employees use electricity, there is water charges. For the generating intangible asset, if you use any overheads, that will be allowed for capitalization. Okay. These are the costs included. What are the costs excluded now? Costs that are excluded. First, selling and distribution costs are always excluded. Okay, selling and distribution costs are always excluded. Second, admin cost not related to intangible asset. Say for example, salary of a chartered accountant for creating a software, no, doesn't matter. Software engineer salary is included, but CA, if he is not directly involved in IA, suppose some people are directly involved. Say you are creating a finance software, so you need a chartered accountant need for telling them what kind of software requirement and all will come. Now those things are covered, but he is taking care of the normal GST tax related compliances, that is not covered over here because it is admin, which is general in nature. Then third one, abnormal losses. If there are any abnormal loss, you have to exclude them. Don't consider that here. Okay. Fourth, staff training. If there is any staff training, they are excluded. So these costs are excluded from the capitalization perspective. Do not consider that for development phase costs. These costs are totally excluded. Okay, so this is how you have to consider the development phase internally generated stuff. Now, after that, there are certain costs which are always treated as expenditure and transferred to P&L. Even though you find that you will find that it's like intangible, it's not like intangible asset, therefore only they said it's expenditure. But still, even though it looks like intangible, it can never be capitalized, it should always be transferred to P&L. Okay, so even though it is an intangible, it should always be transferred to P&L. What are they? Number one, expenditure on startup activities. So to start something, whatever anything is created, until and unless it comes under AS 10 definition, if it comes under AS 10 definition, it will be tangible asset. You'll capitalize it as PPE. If it doesn't come anywhere, intangible, though it doesn't come. So therefore, any expense on startup activities are excluded. Second one, training activities, staff training or any other training activities you are giving, because that doesn't lead to an efficient intangible asset. You train them first to check whether they can do it or not. Now that also, if you keep on adding to intangible asset, it's over capitalization. It's not actually given to generate an intangible asset. Suppose if the training is leading to intangible asset, then you can prove it, then fine. If not, then directly expense it and transfer it to P&L. Third one, very important, advertisement. Now, advertisement is always transferred to P&L. You may say, sir, advertisement will lead to future economic benefit. Advertisement costs are measurable. Advertisement costs are identifiable. It doesn't have physical substance. So can't it be an intangible asset which could be capitalized? The answer is no. Because advertisement is only giving information. It will never lead to sale, confirmed. For example, you have got different phones which comes as advertisement. You own only one of them. You don't buy everything. So you find 10 ads of phones. You will not buy all the 10 phones. You will buy whatever you need. That too when you need it. So that basically means advertisement is only as an information that our phone is available at this cost. It doesn't directly lead to sales. So therefore, it's always transferred to P&L. It's not considered as intangible asset. Okay. Fourth one, any cost related to relocation or reorganization. Those costs are excluded and always transferred to P&L. You find any intangible effect? No, it will be transferred to P&L altogether. Okay, so these costs are taken out towards P&L. Next, if there are any subsequent costs incurred, you have already generated an intangible asset, you have already purchased an intangible asset, but afterwards you are incurring certain expenditure on them. Can it be capitalized? A question comes. If there are any subsequent cost on this asset, can we allow them to be capitalized? For that we say there has to be again future economic benefit, okay, and cost should be measured. Based on the extra expenditure, the subsequent cost you have incurred, it should lead to future economic benefit and cost should be reliably measured. Now, future economic benefit is not just future economic benefit, which means it basically means increased benefit compared to before. So because of that cost, there has to be future economic benefit. So which means before there was certain benefit, because of this, the benefit has to get added on. For example, in an app and all, they will have bug fixes. Now, bug fixes are what? To make sure that the old original app works fine. This is not generating a new benefit because of that particular expenditure. Do not capitalize. However, they give an update for a game and it will enhance the gaming experience. What happened? It is giving you more benefit compared to before. That allowed is capitalized. Otherwise, it is not capitalized. Okay, so those are the subsequent costs which are allowed to be capitalized. Rest everything will again go to P&L. So these are the cost situation for your intangible asset. So different situations, in that important one is internally generated intangible asset. Okay, then the next topic is about amortization. So what do we mean by amortization? Basically charging intangible asset over the life of it. That will be my amortization requirement. First, when it comes to amortization, what are the need which we have to understand? First, amortization depends upon the methods. What are the methods allowed for amortization? First and the foremost thing, amortization is compulsory. You cannot say that intangible asset is forever. You have to write off. So amortization is compulsory. There is no choice. Okay. So what are the methods which could be used for amortization? You can use SLM, straight line. can use WDV, return down value. You can use units of production. Okay, you can use these three methods. In that, SLM is very famous, that we normally use for intangible asset amortization. Along with that, according to expected pattern of consumption. So these methods what you choose will be considered according to pattern on consumption. Okay, if there is no pattern, then they normally apply SLM and finish it off equal. But if you find the pattern, all your methodology will run through that. So sometimes in the exam also they will give you a pattern on consumption. If they give you a certain pattern, go according to that pattern. So take that pattern and accordingly amortize it. Take a ratio depending upon the pattern. For example, consumption wise, year 1 you can consume 20,000 units. Year 2 you can consume 30,000. Year 3 40,000. 2:3:4. You will go for your amortization basis. So that's how the whole thing can be done. So that is expected pattern on consumption. That is the methodology what we will try to choose. Next, useful life. Because SLM and all needs useful life. Even for pattern also you need on the basis of life that will be done. So useful life. First, the normal useful life is 10 years. Maximum I am saying. The maximum useful life what AS 26 suggests us is 10 years. If it is below that, then below that only. There is no choice at all. So the life of the contractual life itself is 5 years. At that time, 5 years only. If you find that it is going for a longer time, but I can't prove it, then 10 years is the time. However, if at all there is a best estimate for more than 10 years and it could be proved, then consider higher years. For example, there is a patent. The patent papers only is saying that the right is for 25 years. So the paper itself suggests that the life of this is 25 years. At that time, there is a contractual nature. You can prove it. Best estimate 25 years, no problem. But if nothing could be proved, maximum 10 years, not more than that. Okay, that will be considered from the useful life point of view. Next, residual value. Residual value. Now, for amortization purpose, you need the residual value mechanism. Now, residual value, how it could be considered? When it comes to residual value, it is always 0. Because normally intangible asset doesn't give you any residual value. However, if at all there is any contract or there is any ready market, again, you have to prove them. If you could prove it, then you can consider the residual value accordingly. Estimate the residual value accordingly. So residual value is normally 0, but if at all there is an outside contract already, a third party has already guaranteed that I'll give you 20,000 rupees, or there is a ready market and you can prove that ready market, then consider that as a residual value. Otherwise, it's always 0. Okay. Now, whatever amortization cost you would have, whatever amortization amount you get, that is charged to P&L. That's the normal mechanism. Any amortization you get P&L. Schedule 3, depreciation and amortization. It will go to P&L. However, if the intangible asset is used to generate any inventory, then capitalize to inventory or add it to inventory. Okay, for example, a particular patent is utilized for production, a particular know-how is utilized for production. At that time, add it to production cost. Otherwise, P&L. Normally, it will go to P&L. So that's how the amount of amortization should be considered. Last part of this particular standard is about disposal. If at all you dispose an intangible asset, what should be normal? If profit or loss on disposal will be transferred to P&L account. So if there is any profit or loss on disposal, add it or transfer it to P&L account. So this is how intangible asset element is supposed to come. So first we saw what are intangible assets, then recognition criteria, costs are the major ones, then amortization, then disposal. So these are the elements which are included when it comes to this particular standard. Now the last part of the standard is to go towards a question based on this, which I have picked it from RTP and MTP again, and let's see how it is supposed to be done. First, I will read the first question. X Limited carries on business of manufacturing of bakery products. The company has two trademarks, Sun and Surya. 1 month before, the company comes to know through one of the marketing managers that both trademarks have allegedly been infringed by other competitors engaged in the same field. After investigation, legal department of the company informed that it had weak case on trademark Sun and strong case in regard to trademark Surya. X Limited incurred additional legal fees to stop infringement on both trademarks. Both trademarks have a remaining legal life of 10 years. How should X Limited account for these legal costs incurred relating to two trademarks? So we have got two trademarks. These two trademarks are infringed by other parties. You want to stop that infringement, so you want to enter into a legal battle. So legal life is 10 years and there is a legal cost worth 10 lakh. Somewhere it's mentioned. No, there is legal cost basically. There is legal cost and the legal life is 10 years. They are asking you how this legal cost should be considered for intangible asset purpose. Okay, what we have learned that if there is any directly attributable cost, it should be added to intangible asset. But look into this question. This question is, the trademark is already created. Sun and Surya trademarks are already there with us. Now, after you have these trademarks, there is an infringement and there is a legal cost, which means can't I consider this under subsequent cost? The answer is yes. It's subsequent cost to me. Now remember, subsequent cost capitalization, what are the rules? The rules are future economic benefit. It should give you additional benefit compared to before, and cost should be reliably measured. Here, costs are reliably measured, but because of these legal costs, will you get any enhanced future economic benefit? No. These costs are incurred to maintain the originality. Therefore, this is P&L. You can't capitalize this. This is P&L. It is not giving you an enhanced future economic benefit. Because you are incurring legal costs, you are not getting any extra benefit. Because you are incurring legal costs, you are maintaining the benefit. Otherwise, you will lose that also. So therefore, these costs are incurred under P&L nature, not under capitalization nature. So that is what is covered in the answer also. So if you read the answer, it will mention the same thing. I have shared it with you. So look into the answer later. Next, the next question. Sudesh Limited acquired a patent at a cost of rupees 2 crore 40 lakh for a period of 5 years, and the product life cycle was also 5 years. The company capitalized the cost and started amortizing the asset at rupees 48 lakh per annum. After 2 years, it is found that the product life cycle may continue for another 5 years from then. The net cash flow from the product during 5 years were expected to be 36, 46, 44, 40 and 34 lakh. Find out the amortization cost of the patent for each of the years if the patent was renewable and Sudesh Limited got it renewed after expiry of 5 years. Now what is happening? First, they have assumed that the life is 5 years. Okay, consider that. Then they went with 48 lakh per annum amortization SLM. So they considered 48 lakh per annum amortization, which is 2 crore 40 lakh divided by 5. But after 2 years, they are expecting another 5 years from the asset. So total it is now becoming 7 years. After 2 years, another 5 years. And they gave you pattern. So what is happening here? Initially they were in SLM. Now they want to shift it towards a pattern based amortization. Now first thing, can this be changed? The answer is yes. This change is change in accounting estimate. So therefore, prospective accounting should be done. Don't do any retrospective accounting. Do only prospective accounting. How it could be done? See, 2 crore 40 lakh we had. 2 years we amortized it. There was old methodology, we amortized it. How much did you amortize? 48 lakh at the beginning. Year 1, 48 lakh in year 2. Done. So 48 lakh in year 1 and 48 lakh in year 2. You did. What is the book value as on year 3? 1 crore 44 lakh. You will find 1 crore 44 lakh as on book value for the year 3. That book value of 1 crore 44 lakh should be distributed according to pattern. So pattern is what? 36, 46, 44, 40 and 34. Total is how much? 200. They have written amortization ratio. You need not write that if it's not directly needed. Basically, the calculation is just 1 crore 44 lakh into 36 by 200 into 46 by 200 and it goes on. According to this pattern, keep on amortizing it. You are going to get your total amortization figures. So that's how it should be done. So prospective, till the date of change, follow the old one. After the date of change on the net book value, follow the new one and finish it off. So that's how amortization element is supposed to be done. I hope it is understood. Just look into the calculation methodology, will be able to understand them. So these are the ones which we need to consider from AS26 angle, which is talking about intangible assets. Okay, with that, the one final accounting standard which is going to remain, which is going to tell us about related party disclosures. So one last standard. Now let's start discussing about it. So covered by AS18, related party disclosures. Okay, now basically why this standard comes into effect? First of all, this is a disclosure standard. We don't talk anything about measurement or anything like that. This is basically a disclosure standard. Why the disclosure is important? Because it's a related party transaction. So since it is related party, the user should know what the enterprise has done between their related parties during the year. It cannot just leave them just like that. So there might be chances of fraud and all these stuff when it comes to related parties. In auditing, you learn that in detail. But accounting said whenever you have got a related party relationship, disclose them. Okay. Now, what is a major inclusion of this standard then? What are the major ways in which this standard could be considered? First, what type of disclosure is supposed to happen? The related party and the transaction entered with the related party. So first you have to tell who are the related parties. So you may have entered the transaction, you may not have entered the transaction. First, for a period, who were the related parties? Then what are the transactions involved with them? Okay, so when there was a related party relationship, if any transactions is entered, that has to be set. Now the point is whether these related parties should be related party as on balance sheet date. No, it need not be. During the year is enough. Okay, so for a particular period of time, they were under related party relationship. Then for that period, whatever transaction has been entered into, show it. But as on 31/3, they are not my related party, doesn't matter. After you lose related party relationship, if you enter into a transaction, that also need not be disclosed. For the period of related party relationship, disclose them. Afterwards, you need not, and it need not be as on 31st March as well. Okay. Now, for you to disclose it, there has to be related party relationship. So, related party relationship is basically the need of AS18. If anything should be coming under related party, there needs to be a related party relationship. Only those things coming under related party relationship should be recorded or disclosed. Other things are totally left. Okay. Now, when it comes to related party relationship, what are the things coming up over there? There are a total of 5 points. These 5 points are coming under related party relationship. Consider them and it will be over. First, one by one, I'll start telling you what comes under related party relationship. First, there is an enterprise. Okay, there is an enterprise who controls or who is controlled by or who is in common control with reporting enterprise. I will now call this as RE. So first, there is an enterprise who controls reporting enterprise, who is controlled by reporting enterprise, and who is in common control with reporting enterprise. So all these things are with reporting enterprise. All the 3 points comes up with this regard. So reporting enterprise is the enterprise which is going to report it in the notes to financial statements. For them, what are the related party relationship? Example, there is A Limited. Let's keep A Limited as our reporting enterprise. Okay. For us, A Limited is a reporting enterprise. Okay. There is one holding company to this. Say call that X Limited. So what is happening? There is X Limited. There is an enterprise who is controlling A Limited, reporting enterprise. So therefore, this became related party. Then say A Limited also has a subsidiary, say B Limited. And what is happening now? There is an enterprise which is controlled by reporting enterprise. So automatically what happened? Even B Limited is related party. I hope everybody are able to understand who controls. So X Limited controls reporting enterprise. So X Limited became a related party. B Limited is controlled by reporting enterprise. So B Limited became a related party. Now who is under common control? Assume that for X Limited, there is another subsidiary called as C Limited. For X Limited, there is another subsidiary called as C Limited. Now, our reporting enterprise and C Limited, are under common control of X Limited. Therefore, A Limited and C Limited now again are related party. Okay, so again I repeat, so this is for third point. The one which I have marked in red is for third point. So we are under common control. Then second one basically is controlled. So basically reporting enterprise is controlled. That is second point. Then first point, X Limited situation, where X Limited controls the other one. So this is how you have to consider the first point of related party. So either I was controlled or I control or I am under a common control. That will be considered as my related parties. Group concerns is we normally call them. Next, second one. We will talk about these control. What do we mean by control? What do we mean by influence and all a bit later. But yes, we will see whenever there is control, significant influence, etc. Second one. There is either an associate, okay, there is either an associate or there is a joint venture. For this, there will be an investing party. For this, there is venturer. These are related parties. So associate and investing party, joint venture and venturers are related parties. Assume that say there is a joint venture. Okay. What do you mean by joint venture? Venture between two people. So for this joint venture, there is A Limited and there is B Limited. These are the joint ventures. Okay. So joint venture is the venture we have, and A Limited and B Limited are called as venturers. So what is the point telling us? Joint venture and the venturer are related parties. Okay, but very important, A and B are not related parties. because the standard did not tell the co-venturers are related party. No. They said only joint venture and the venturer. So joint venture and venturer are related. Between the venturers, there is no related party. In the same way, associate and the investor are related party. Between co-investors are not related party. Okay, so there is an associate and there are investors. So one associate, there has to be significant influence to call something as an associate. So there are multiple people of that sort. Now at that time, those multiple people are not related party. Only the associate and the investor are the related party. This is the second element. Third one, there is an individual along with relative. There is an individual along with relative, okay, is either having control on the reporting enterprise or significant influence on reporting enterprise. Here now individual came in, human being. So there is an individual, either that individual along with relative, everybody has got either control on the reporting enterprise or has got significant influence on the reporting enterprise. Both, any one of them is fine. If they have it, they are related parties. So who are related party? Individual, relatives, everybody are related party to that particular reporting enterprise. This is the third one. So if I have to give you an example, say there is Mr. A and there is Mrs. A, husband and wife. Now, Mr. A has got 10%, Mrs. A has got say 44% stake in reporting enterprise. So total is coming up to what? 54%. This gives me control. If there is control like this, then automatically with the reporting enterprise, we are related parties. Okay, so that's how it should be done. So individual along with relatives, both of them are supposed to get considered for this. Okay, then fourth one, key managerial personnel along with relatives are always related parties. Okay, now a question comes, according to AS 18, who are key managerial personnel? Okay, according to AS 18. Now, key managerial personnel are those people who has the authority and responsibility. Okay, these are the people who has the authority and responsibility for what? For planning, next directing and managing the affairs of the company. So whoever has the authority for planning, directing, managing the business of the enterprise, those people are called as key managerial personnel for the purpose of AS 18. So again, understand this, the people who has got the authority to plan, direct, manage, etc. Those people are considered for the purpose of key managerial personnel. So therefore, these particular key managerial personnel will be divided into two then. One, executive directors. Now, who are executive directors? The one who conducts business of the company. Now, executive directors, if you now look into it, are they coming under these authority, responsibility for planning and all? The answer is yes. So therefore, these are KMP. Then non-executive directors. Now, who are non-executive directors? They don't take part in the business. They are only there to watch whether these people are properly functioning or not. Is there any illegalities happening? And all these things are covered over there, which means those people are called as non-executive directors. They are mainly restricted for meetings. Therefore, for the purpose of AS 18, they are not KMP. So therefore, just because there is a name as director, I will now never become a related party. But understand, I am a non-executive director, but I have got 41% stake in the company. Non-executive director, hypothetical situation, non-executive director, and I've got a 41% stake in the company. At that time, what happened? Non-executive director, I'm not covered in point number 4, but 41% stake, I'm covered in point number 3. I am a related party, but according to point number 3 and not point number 4. Okay, then the fifth and the last point. Fifth and the last point. Okay. What does this tell us? This tells us that there is an enterprise. Okay. There is an enterprise is controlled by people covered in point number 4, sorry, point number 3 and point number 4. Okay, there is an enterprise which is controlled by point number 3 and point number 4, obviously who are related to reporting enterprise, and there is a transaction between this enterprise and reporting enterprise. Even these are called as related party. I am an individual. I'll give you an example. I am an individual. Okay, so there is Mr. A. He owns 28% in company A. Okay, and for our understanding, let's keep this as reporting enterprise. Now, A is not having any transaction with company A. If A has transaction with company A, what happens? A is related party, because point number 3 says so. He is related party. Now, he doesn't have any transaction with company A. Instead, what he does is, he will create a firm, partnership firm, where A has got 70% stake. He will create a partnership firm where A has got 70% stake. This partnership firm will have a contract with the company. Now what happened? A is not doing it directly. It is doing through firm. Firm cannot have a share in company A. So company and firm does not have any direct relationship. There is a common person called as A. Through him it is happening. So therefore, even this is also covered by related party transaction. Okay, so if you don't do it directly, even if you do it indirectly, it doesn't matter. It is leading to related party. Now, certain things we have to understand. So 5 points, let's quickly remember. 1, control or getting controlled or common control. Number 2, associate or joint venture. For associate connected to investor, joint venture connected to venturers are related party. 3, individual along with relative exercises control or significant influence on the reporting enterprise. 4, key managerial, personnel and relatives. 5, enterprise through which it is supposed to be done. So those are the 5 points covered under related party relationship. Certain terms, let's now try to understand. Number 1, what do we mean by control? When can control possible? Okay, when control is established. Number 1, shareholding more than 50%. When shareholding more than 50% is considered, then it is considered as control. Second, when you control composition of board of directors. When you control the composition of board of directors. Okay, so I control the board of directors, the appointments and all these things, I take care of it. So I will be a controlled person. Third, there is a significant influence. There is a significant influence and controls the policy making of the company. So there is a significant influence, but it doesn't establish control. But I am also involved in controlling the policy making of the company. I will be considered as person having control. This point is not that common, but yes, it's a point included in the standard. Okay, these 3 points will tell you whether there is control or not. Next, significant influence, which leads to associate relationship. Okay, when you have significant influence, it leads to associate relationship. When there is shareholding more than 20%, obviously less than 50, but more than 20%. We call that as significant influence situation. Then, who are relatives? Who are relatives? So we consider that in point number 3 and 4, individual, KMP along with relatives. So 1, it will be parents, so mother and father. Then it will be siblings, so brother and sister. then it will be spouse, then son, daughter. These are the relatives for the purpose of point number 3 and point number 4. So father, mother, brother and sister, spouse, son and daughter. Don't consider anybody else. For example, grandfather, grandmother, no. Brother's wife and sister's husband, no. All these people are excluded. Only these people are considered as relatives for the purpose of this particular standard. Okay, so these are the things what we need to understand from the related party. What are related party relationship we established. Afterwards, what things will be disclosed? A transaction with these related party will be disclosed. But there are certain exclusions from related party. Exclusions from related parties. What are the things which are excluded from the related parties? Okay. Two companies because of a common director. Two companies because of common director. Okay, just because there is a common director between two companies, you can't consider those two companies as related party. Okay, don't consider that at all. They are excluded from related party element. The second one, single customer, supplier, franchisee, etc. Okay, just because they are my single customer where the voluminous transactions are very high, at that time they just don't become my related party. They are one who we have initial transaction with, that's true, but still they don't be called as a related party just because they are my customers. Okay, then third one, your providers of finance, then trade union, public utility, etc. Again, you'll have voluminous transaction. You are dependent on them for finance basis and all, but still they are not related party. You are just dependent on them for getting finance. So there is no related party relationship as such. So you need not consider them. Then there are certain exclusions from disclosure. There are certain exclusions from related party disclosures. Okay, they are related party, but you can exclude them from disclosure. One, to maintain confidentiality. There are certain transactions where confidentiality is very important. If at all that is the case, they need not disclose it. Example, it leads to certain sensitive information about the country. A company is involved in government of India. There are certain sensitive information that cannot be disclosed for everyone. So those things will not be disclosed as related party transaction. Second one, whenever there is consolidation, mutual transactions are excluded. So during consolidation, mutual transactions are excluded. So those need not be shown because AS21 specifies that it need not be shown. So those are excluded. Okay. So these are the ones which are covered under the related party element. So first, what are related party relationships? Then what are the exclusions coming under this particular standard? You know this much, more than enough from the syllabus point of view of AS8. Okay, now let's quickly look into the questions of this particular standard. We'll try to understand them. First, on the basis of provisions of AS18 related party disclosure, identify the related party in the following case. X holds 60% shares of Y. So I will just draw it for you so that we will see how it could be interpreted. X and Y, there is a 60%. Great. Then Y holds 55% of W. Y holds 55% of W. Then Z holds 35% of W. So there is another company Z and this holds 35% of W. Considering this, now let's decide whether it is related party or not. So try to understand. Control can be direct or indirect. Influence can be direct or indirect. Anything is fine. So first, whether X and Y are related party, yes, because control is there. There is control between X and Y. What about y and w? Again, it's there. So x to y, yes. Y to z, yes. Sorry, y to w. I'm sorry, y to w. Y to w again, yes, because there is control between them. Reason being control. Correct. What about x to w? What about x to w? See, x is controlling y is controlling w, means x is indirectly controlling w. So therefore, even there is control over here as well. So therefore, it is considered as related party. What about w to z? There is again significant influence. So they are related party. So x and y are related, y and w, and x and w. So x, y and w are related party. Z and w are related party. But is there any connection between z and x and z and y? No. It's not getting controlled. There is no common control, nothing. Therefore, z is excluded from related party between x and y. So final conclusion is what? X, Y, Z are related parties. Sorry, X, Y, W. Really sorry. X, Y, W are related parties between themselves. They are related party altogether. Then Z is related only to W. Z is not related to X and Y. Z is only related to W. But X, Y and W are internally related to each other. So that's how this whole answer should be taken. See, X, Y and W are related to each other. Z and W are related to each other. But neither X nor Y is related to Z. That is what we concluded here also. Okay, next one. Himalaya Limited sold goods for rupees 40 lakh to Aravalli Limited during financial year ended 31st March 2019. The managing director of Himalaya Limited owns 80% shares of Aravalli Limited. The sales were made to Aravalli Limited at normal selling price followed by Himalayan Limited. The chief accountant of Himalayan Limited contends that these sales need not require a different treatment from the other sales made by the company, and hence no disclosure is necessary as per AS 18. You are required to comment on this. Okay. Now if you remember, this is covered by point number E. Check here. There is Aravalli Limited, A Limited, and there is Himalayan Limited. Correct? Now, here there is a director who is owning 80%. So, director of H Limited owns 80%. So, there is a control. Control in an enterprise where for the reporting enterprise he is related according to point number 4. Now, they are having a transaction. This is point number 5, related party relationship. So, person covered in point number 3 or 4 controls one entity. Then that entity has a contract with the reporting enterprise. It's a related party. Now, they are not saying no for that. They are saying, chief accountant says that sales need not require a different treatment because they are made at normal selling price. Doesn't matter. You sell it at normal selling price, you sell it at arm's length price, you sell it at a discounted price, doesn't matter. Related party should be disclosed if it is covered in point 5 or any 5 points. Therefore, it should be disclosed. So it doesn't matter whether he is supposed to be done under normal selling price, arm's length price, less price, more price. No. Just the basis is whether it comes under 5 points, that will be taken up. So check here. Himalaya and Aravalli are related parties since key management of Himalaya Limited holds 80% in Aravalli Limited. Okay, and hence disclosure between them is required irrespective of whether the transaction was done at normal selling price. You have to do it whether whatever price it is. So accordingly, that will be considered. Okay, so with this we even finished AS 18 discussion.